the Kenyan National Treasury has indicated shelving intentions to go to the commercial market via Eurobond. What financing options does the IMF see for countries such as Kenya, whereby on the one hand, the global financial conditions are tightening, and on the other hand, is pressure not to crowd out the domestic market? And secondly, IMF just concluded the third review of Kenya's program with a very rosy review of the monetary environment. Here we are facing a crippling dollar shortage. What's IMF's assessment of Kenya's FX position? And how do we harmonize the rosy assessment versus the reality on the ground? Thank you.
Thank you.
Thanks. So, I think Kenya is a good example of a country that was hit very, very, badly, of course, by the pandemic. Tourism sector suffered, much the rest of the economy, but has also taken really very impressive measures to try and deal with the legacies of the pandemic. I think over the last year, it's been really impressive to see the government advancing quite a few economic reforms. And, I was, happy to see, for example, in the current fiscal year, 21-22, tax revenues are expected to overperform, albeit by a small margin. And this, of course, will be helpful to defray some of the costs of, increased support that the economy is going to need as a result of this latest shock, without the deficit necessarily needing to widen. So I think this is a welcome step. This shock, as we were discussing earlier, is really, really problematic for our countries. Why? Because it's going to affect imports, the import bill quite a bit. So it's not surprising that, we're seeing, some pressure on exchange rates coming from this shock. And indeed, in countries like Kenya, where the exchange rate is flexible, where you have, relatively deep and liquid financial markets, allowing the exchange rate to move is, I think, as the Bank of Kenya, Central Bank of Kenya has done, the right policy step. I think, in the highly uncertain global environment we face, making sure that reserves remain adequate, there is some exchange rate flexibility to absorb this is all important. In terms of the financing outlook, I think, what the government strategy has all along been is to have a balanced approach in terms of financing, and depending on international market conditions, domestic market conditions, to go to what would make sense. And I think it's really nice that Kenya is in that position. It reflects its relative economic strengths, that it can, make sure that it goes for what is optimal in terms of debt management strategy by way of financing sources. And I'm sure, I'm not aware of, this recent decision that you made, but I'm sure kind of that decision will be made by Kenyan authorities, reflecting on what will make sense, and with due regard to, any effects it could have on domestic crowding out, and the other considerations you noted.